My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends just trying to make you some money. My job's not just entertainment, but educating teachers, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. We've got protests all over America that in many places turned into riots. What does the market do? Rallies. Dow gaining 92 points, S&P advancing 0.38%, NASDAQ climbing 0.68%. So how do we interpret this action? Is the market totally heartless, indifferent to the pleas of the protesters? Is it condemning police brutality or endorsing it? Is the market making judgments about the difference between violent protests and passive resistance? I know many people wish it would. They want the market to be part of the debate. They want it to play a constructive role in the dialogue over racial equality. Or at least they want it to go down to express some empathy for the troubled times we're living through. That's not how it works. The truth is, the market's blind because it has no eyes. It's deaf because it has no ears. It's a convenient abstraction, not a person with opinions. Of course, individual investors make judgments, but I got to tell you, until very recently, nobody was investing with an eye toward making the world a better place, whatever that might mean. While there's now a younger generation that invests with their hearts as well as their heads, and I share a lot of that sentiment, for the most part, people still pick stocks because they're trying to make money. You buy stocks at companies, good companies, with good long-term prospects, meaning the ones that won't be hurt by the protests by COVID-19, ideally with powerful long-term trends that will boost them no matter how these situations play out. So just to be crystal clear, no, the stock market doesn't care about social justice. Maybe you think it should. It's not my department. But for the most part, that's just not how things work. You could say investors are myopic. I'd say they're myopic because it tends to produce better results. Classic example, China. Chinese government's terrible. You may be furious at China for initially dropping the ball on the coronavirus. I know the president is. But unless this new round of the trade war escalates to the point where it hurts American business, it probably won't impact your portfolio. Personally, I'm worried that President Trump has gotten so hard line against China that it might jeopardize our special relationship with Taiwan, an obvious target if they want to escalate. And Taiwan has a huge semiconductor industry and a great one. It's vital American interest. I'm concerned about what will happen to our companies that do tons of business with the People's Republic. I'm talking about companies like Nike, Starbucks. After the close, by the way, Starbucks had an announcement. It's all in line. There's no new news there. And, of course, I'm always going to be worried about what happens with Apple. Other than that, though, all this sound and fury about China simply isn't actionable. Is it an important story? Of course. In terms of geopolitics, it's a huge deal. In terms of trying to make money, not so much. So with that in mind, let's circle back to the protests. From my perspective as a money manager, what worries me is how all this will interact with the pandemic. I would never condemn peaceful protesters exercising their right to demonstrate and speak their minds. At a time of sky-high unemployment, you got to figure that the whole country's a powder keg. But we also know there's a deadly virus going around, and big gatherings are exactly where it spreads. When you look at these videos, there's not a lot of social distancing and far too few masks. This is the mother of all super spreader events. And that's why I'm concerned that we're going to get a huge second wave of infections far earlier than people thought. Plus, in the places where protests turn violent, it gives businesses another reason to shut down or keep their employees working remotely. From this stock market's perspective, everything that happened this weekend means the stay-at-home economy will last longer than we thought. We have to hope that rebuilding generates immediate openings to put people back to work, but don't bet on it. This is an extension of the stay-home economy. So let's think about the individual stocks that benefit from the stay-home trend. Let's circle back. Sure enough, they rallied today. Not because they're spitting in the face of the protesters, no, but because what's happening now helps their bottom line. So let's talk about the most obvious. Let's talk about Zoom. Zoom Video, up nearly $25 today, a huge run in advance of its earnings report tomorrow. Out of nowhere, Zoom has become a $57 billion behemoth. That's a major part of our lives. It's easy to use with a freemium business model, newly heightened security that curtails Zoom bombing, and it was the biggest winner from the lockdown. If that lockdown continues for different reasons, it still wins. Zoomy boozy brunches, Zoomy lectures, even Zoomy shivas. It's all on tap. Zoom's running today because there's a decent chance it might go higher after it reports. You know, in my 40 years of investing, you rarely get situations like this. Normally, it's a sucker's bet to buy a stock that's up more than 13% the day before it reports. Buy high and sell higher is a bad strategy, people. But in this crazy market, anything can happen. Second, as great as Zoom may be, the work-from-home movement has created some huge cybersecurity vulnerabilities. It's just much easier to protect your network when everyone's in the same building using the same computers. Now people are spread all out, and it's spread all over. And by the way, they're using different machines. That means there's incredible demand for cybersecurity software, and the companies in this industry can make a fortune. For example, last week we spoke to Jay Chaudhry. He's the CEO of Zscaler, the cloud-based security play. He delivered a terrific quarter, and his stock exploded higher. It's one of the year's best performers. I wanted him on because in this cybersecurity market, I knew Zscaler wasn't done going up. I wanted you to have it bring it to your attention. Multi-day run. Sure enough, with the protests spreading COVID-19 and likely extending the lockdowns, Zscaler surged another 12% today. Again, you have to understand what the market's actually sensitive to. As long as there's a huge level of enthusiasm for stocks like Zscaler, Okta, that's a Cramer family favorite, Fortinet, Proofpoint, CrowdStrike, which reports they have to close tomorrow. The averages can keep climbing. These cybersecurity plays were practically made for this moment, hence the Cramer COVID-19 index. When people are afraid to shop and afraid to go outside, that means more customers for Amazon. Again, in this tape, a likely set of keystrokes to order something from Amazon translates into more keystrokes to buy Amazon stock. Yes, ideally, you want to send your money to small businesses, right? I mean, they're suffering right now. But most small businesses remain closed, thanks for the non-essential designation, which drives still more business to Amazon. Hence, its nice move higher today. What else? We keep hearing about sports opening up once again, right? So what do? Every time you hear it, well, you go buy the stock, of course, of DraftKings. Surged another 10% today. It's the only way to invest in the concept. Is the online sports betting company really worth $13 billion? The question's irrelevant, people, to this set of buyers who take it up every single time there's news of an opening day anywhere. Who else wins from the stay-at-home economy? Well, how about this one? Facebook. It launched a brilliant initiative. Facebook Shops to help small businesses operate online. They're the natural ambassadors for Facebook. This is something that could turbocharge the company's growth rate at a time when their core ad business, some say, is flagging. Finally, there's DocuSign, the ultimate bettors of the stay-at-home economy. Their software lets you sign contracts digitally. You don't have to go to some lawyer's office or the bank. DocuSign reports on Thursday. Stock's already up nearly 100% for the year. I think it actually has more room to run. It keeps being discovered by new people. Put it all together, and it's not that the market is totally heartless, although it certainly has no heart. It's that buyers are oblivious to the risk of purchasing stocks that have run and then run some more. You could say they're being reckless. The strategy, though, is making money. Maybe it's some sort of discipline we don't know. Bottom line, at the end of the day, the market has no conscience. Investors are simply trying to make money, and that's why they're crowding into the stay-at-home economy stocks, as I keep telling you, because the stay-at-home economy just got a major extension for many investors, right or wrong. Thoughtless or cerebral, it's worth exploiting. I want to go to Chucky in California, please. Chucky.
Hey, Chuboya to you, Jim. How are you?
I'm doing good. How about you, Chucky?
Oh, great. Thank you. So my question will be for you is about Tesla. You know how much you love Tesla, but they're up like 7.5% in one day. That's great. So my question would be, buy or wait?
I think Tesla goes to 1,000. We'll reevaluate it there. It doesn't need ads. It's got a business that is about to, I think, take China by storm. Maybe the United States not that strong. That German operation is going to be terrific. So I am totally in the Tesla camp. Let's go to Luca in Texas. Luca.
Jimmy Chill.
Yo.
Thank you for taking my call.
Of course.
Long time Action Alert Plus member. You made me a lot of money. Thank you.
I am very, very excited to hear from you. What's up?
Jim, 5G is the way things are going.
Right.
My question is, what's your thoughts on Skyworks solution right here for a 3 to 5 years investment?
Oh, you want to. Liam Griffin is fantastic. The 5G play is going to be multiple years. It's also why I like Marvell. Had a great quarter last week at MRVL, as you know, because you're a member of the ActionAlertsPlus.com club. So I like Skyworks very much. Hey, how about we go to Stafford in Indiana? Stafford.
Hello, Jim. How's it going?
Not bad. How about you?
Not bad. I just recently purchased a few shares in Dropbox, and I've read articles saying by 2024, Dropbox expects to have a massive amount of cash flow. And I believe in Judy Houston, but I'm a little concerned about, post-coronavirus appeal.
I think Dropbox is a lot like Slack. These are companies that people had said Microsoft has decided to put them out of business, and it can do that, and they're not going out of business. And Dropbox is a popular product. It's not going to be as hot. There's some companies like Zoom that are really taking off, but I think Dropbox is fine. Not my favorite, but certainly not bad. All right, look, these are tough times. But for now, the market isn't participating in that debate, and that's how we rallied. On Mad Money tonight, I'm sitting down with the CEO of one of the hottest stocks on earth, Chipotle. As more economies begin to reopen, I'll get a read on its trajectory. Then, with gold approaching all-time highs, the yellow metal's backed by momentum and the residual effects of the COVID-19 shutdown. But is the move long in the tooth? I'm going off the charts. And my exclusive with one of my absolute favorite stocks, Ulta, after earnings to find out how the beauty business is changing because of the pandemic. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.